Welcome to the Micro Futures Trade Masterclass. Today I'm going to be talking about the trade that opened up about a little less than 2 years ago, and it has really made a big difference for retail traders. And I really believe that this trade is going to be extremely popular. The reason for that is because it's very easy to trade. It is very small positions, and there's no PDT rules, no restrictions on day trading on these. Okay, and the amount of margin that you need to trade this is very small as well. I wouldn't recommend the smallest size. We'll talk about that. Okay, so I'm really excited about this, and you'll see my performance, and it's just an amazing trade. Hopefully you'll find value in it. So let's begin here. Okay, what can you expect from tonight's presentation here? Okay, I'm going to show you how you can make consistent returns monthly based on margin capital risk using micro futures without taking large losses, and make those returns month over month. Okay. So what are you going to learn? What exactly are micro futures? How to enter and exit your trades? How much capital you'll need to trade micro futures? When to scalp or use swing trades? And how to accurately and effectively identify bottoms or tops? And finally, how many contracts you should trade with and how to manage multiple contracts. Okay. Just a quick note on this year's performance of my micro trades. I trade a lot of other things too, but this is not the high because I had some losses. Okay, and this is normal to have some losses, but it's a solid trade. And last year I made like, I don't know, I can't remember. It's like 19,000 for the year. Okay, and I plan to exceed that this year. So trading micro futures, not the big minis, not the minis, but the micro futures. All right. Okay. So let's talk about profitability factors. Really, there's two. It's very simple. You need to get the market direction right. And in which direction does the market usually trade? Up, right? The market is generally going up. And so I position most of my trades doing on the long side. All right. And the second part is trade management. You really know you really need to know how to manage your trade and do that correctly so that you can come out profitable. So trading small and trading often is really one of the keys, and getting the trend right. Okay. All right. So let's talk about risk guidelines and daily routines. So first of all, always trade with a trade plan, right? And the trade plan should include entry and exit criteria, trade size, composition, etc., and when not to trade. Determine max loss or risk reward when entering your trade. Understand that. Trade no more than 20% of your working capital. Number 4, do not allow more than a 2% loss. A lot of traders use 1% loss based on your trading capital, and this will keep you solvent. And size your trades to ensure emotions are not part of the decision-making process. Trade small, trade often. Okay. So just a quick note on that. Sometimes people don't really realize how much psychology has in trading. But if you position, and you want to get in there and you want to make money quick, and that, that's what you want to do. But there's a process, okay, and you really need to learn how to trade and position yourself. And once you get that down, everything else really becomes easy. Okay, so this is really important. The trade size in your trading. Okay, pre-market routine. What do? I review support and resistance areas in the market. That'll tell me where basically there's congestion and when it's going to stop. And just an example today, well, I'll share a trade with you. Actually, I'm going to share several trades, but I'm going to share one of the trades with you that I took on this morning, and just share with you how it worked out. Okay, and using support and resistance. I look at the dollar just because close to 50% of the S&P 500 companies get their revenue or derive their revenue from overseas. Okay, so the dollar down means cheaper prices abroad. So that's really important to understand. It helps the market go up. Treasury notes. I review treasury notes, and I don't know if you've been watching the news or CNBC or whatever, but they talk a lot about that just because inflation, the only way to stop inflation is to raise rates, okay? And so you slow down the economy, slow down inflation basically. And so there's a lot of talk about inflation, and I have my own opinions about that and pretty strong ones, but the types of inflation that causes, the type of inflation that causes problems in the economy are those that in wages, okay? So because that's really sustainable. But the types of inflation that are in commodities, they go up and down basically all the time. If you look at gas, right? Gas is always going up or down. It's just not sustainable for that kind of inflation. Okay, it's really wage pressure. Okay, and we still have a lot of people out of work at this point. All right, so I review ES futures. ES is a symbol for E-minis, right? MES is a symbol for micros, and review what trading direction the market is going in at that time, okay? Before the market opens. I review the VIX, which is the volatility index for the S&P 500. Higher volatility means that you need your positions, your stops probably wider, just because the market is moving much faster and more aggressively, and when it's lower volatility, it's just the opposite. All right, so those are the pre-market routines. The post-market routines is I determine if rules were broken and why. If you're breaking your rules, it means you're not following your plan. It's important that you understand why you did it and go back to maintaining your discipline, okay? Consistently breaking your rules will lead to ruin, I can guarantee you. Determine if risk was within acceptable levels, especially for wins, okay? And the reason for that is because when you're risking too much and winning, it creates complacency, and that will eventually catch up to you. All right. Determine if losses were within acceptable ranges. The reason for that is too big of a loss and too small of a too big of a loss and too small of a loss is not good. Big losses are due to position size too large or breaking your rules. Losses that are too small means that you're either trading with fear or you're just not risking enough to offset the eventual losses that you will have. Okay. And you want to have small losses. Determine tweaks if adjustments are necessary in your trade plan, and update your trade journal with your findings just to make sure that you keep a check on yourself. All right. All right. Let's move on here. So now we're going to talk about the actual trade strategy for micro futures. Okay. First thing is these are 2 of the 4. The other 2 that are missing are the Russell 2000 futures and the Dow futures, okay? Micro futures. I trade MES, which is the futures for the S&P 500, and MNQ, which are the futures for the NASDAQ 100, right? And so you can see there the position size of each. I can just tell you the normal margin requirement is 1,200 and 1,700 for overnight trading. But if you open a Trade account, it will allow you to have that little bit of margin for each contract on that little bit of margin that you need for each of your contracts. Okay, for day trading. I wouldn't recommend to trade that small, because this is a leveraged instrument, and it could could go against you the wrong way. And if you have a $100 account and you lose $40, well, that's a big chunk, right? So what I recommend is always at least $3,000 per micro that you have. Okay, all right, that's that. And let's talk about the trade setup. So this setup is for longer term MES and MNQ swing trades, all right? And I typically enter a long position, going, basically positive, not shorting. I do sometimes short, but typically the market moves aggressively, quickly down, right? And takes a while to move up. It kind of grinds higher and swings aggressively down. That's kind of how the markets work. Okay, so in this is a little bit of a technical part, and we're going to talk about ABCD patterns here. And that's really the patterns that I use is the ABCD pattern mostly. So the pullback and the fib retracement, and I'm going to show you a diagram here in a second, of the C in the ABCD pattern falls between 0 and 23.6%, and not to exceed 38.2%. So here's an example, right? So so this is the A, B, C, and then D is up here, which you'll see in another slide. Okay, but this is a Fibonacci retracement, and so we draw from the bottom left to the top right on the Fibonacci retracement, and that's how you get your fib lines. All right, so so that's the percentage from the bottom. So the percentage from the bottom, from 0 to this area here, is the 23.6 area. And from here to here is the 38.2 area, all right? And so what I mentioned in the back here is that C falls between 0 and 23.6, not exceeding 38.2. So the most, when you're placing a trade, this area right here, the bottom, okay, this part right here, the C level, doesn't exceed this 38.2 area, okay? You want it to come down here, and basically what it's doing is it's testing the low, all right? So that you have confidence that it's not going to continue going down. However, sometimes it does, and that's why we have stops. So let's move on here. All right. So let's talk about trade entry and management. So one contract is advisable with an account that is less than 10,000. Entry should be on a pullback between the 38.2 and 23.6, as I mentioned before. That's a retracement after the C leg is identified. And then entering below 23.6 is riskier. It can be done, all right? But you're really close to the bottom, and it could, you know, when you're that close, a lot of times it could continue falling and take out the low, and then you know you're ending up with a stop loss. And so, but anyway, that's just one alternative in trading this. And after entering the trade, the initial stop loss is set at a support level below the A leg. Okay. Now, when I set my stops, I set them wide, which means far away from the position, because I trade very small. And what I do is, if the market goes against me, as long as I have the trend right, okay, it'll go down, and then many times I'll add a contract as it's going down. So I'll basically add positions as the market's going down, and then when it goes up, right, I'll get a larger profit. Now that's a little bit dangerous, and you have to be confident of your, you know, of what you're doing to do that. Okay, that's when you gain experience. So the initial wide stop is broken. An alternative entry is identified and entered with a new stop. Okay, so what happens is, what I do is I place my stops basically so that it's not a catastrophic loss. It could be a little bit larger loss than normal, but it's not a catastrophic loss. And so a lot of times I'll trade at night, I'll put my stops in, I go to sleep and let it run. Okay, I don't have to be watching the screen. A lot of times I'll be trading during the day, and I'm trading a lot of different things, and I don't have to watch it consistently. Although I have my charts up, right, I'm not concentrating on that, because I put in my stops and my targets, and I move on to other things. Okay, so you don't have to be sitting in front of a screen. All right. So so what happens is if that stop loss breaks, I'll wait to see what happens. Okay, is the market going down? And I can tell you yesterday, yesterday when the market was really going down, you know, it broke one of my stops, and I just left it and looked at what was going on. But right after that, the market continued going down. So obviously I didn't put on another position. I just waited and let this thing go, okay, until this morning when I actually traded that position. All right. So again, here's the entry. You want to enter right around that area right there, and that's really, really ideal. Okay, that's really the ideal area. So you have a drop here, a nice, you know, and it didn't touch the bottom part of this. Okay, it didn't break the A leg, and you have a nice strong candle here and continuation candles. So that's basically a perfect entry to your trade. Okay, all right. I try to do this as much as possible. Now you can use this on multiple time frames. You can use it on, I use it on hourly for the most part because I swing trade and my trades are longer in duration. It could be from several hours to a couple days, okay, that I trade. And then move on from there, okay? Okay, profit targets are established based on fib extensions. Okay, so what we talked about what we were talking about on the graphs on the charts that we're looking at, those are fib retracements. So what I'm going to be talking about now is a fib extension, right? So profit targets should always be taken between the 100% and the 125% fib extension level, and here it is. So this is a tool that we use in Thinkorswim, okay? And so you get the extension tool, and what it does is that you have to chart your A, B, and these are pivot areas, right? So the bottom where it pivots, and the top B part where it pivots, and then the C part where it pivots, right? This is the same chart I was just showing you where the retracement was. It started over here. So this is the extension now, and it shows here on this side, okay? So the extension is basically forecasting where the market's going to go, okay? And so when I said 100 level or 125 level, that's what I was talking about, okay? All right. So when I enter my trade here, I wait, I put my stop below the A, I set my target up here to the 100 level, and I just let it run, okay? That's what I do. And so this pattern works over and over and over again. It's a repeating pattern that traders use, and it just works. Now, sometimes it doesn't reach the target, but some things that you can do when you're waiting for this trade is, for example, let's say you enter the trade right down here, okay? And then it moves up a little bit to this area, okay? And you say, okay, great. So now I've got a profit. So why don't we set a stop loss? Now I can move my stop loss to here where I entered, okay? And if it goes down, the worst that can happen is I break even, okay? So a lot of times I'll do that. A lot of traders will do that. So in this case, or and after you put that break-even stop loss in, the market will go down here, and it'll, you could see a pivot here within this trade, right? So you say, okay, so now I can move my stop loss up a little bit, and I'll put it right under this candle, right? So now you can be assured that you're going to get out of this trade with a profit. And so I typically do this as well. And then the other way that you can do this is you can actually set a trailing stop to where, where the market is just continually moving up. And as the market moves up, so does your stop loss automatically. Okay. So that's just another way that you can put stop losses in. All right. So now let's move on to some other technical things that we use as traders to identify areas of support and resistance. So the IB, which is initial balance, you have an IB high and an IB low. The both initial balances take place within the first hour of trading. Okay, so and those are your levels. Now traders use those. Okay, so in this case, the low was made, and it didn't break the low within the first hour. So this would be the initial balance level. Secondarily, on the high within the first hour, okay, you can see another high here, but that wasn't within the first hour. It's 9:30 to 10:30. So this is where you have your initial balance is set. Okay, so the high during this range here was set here, and so traders will use this to basically trade breakouts or fake breakouts like this one here and short. So you go down. All right. I don't typically use this, but it is a type of trade that you can use. So here's the longer term chart on it. You can see where at 10:30, right, we made, by this time here, right, the trade was done, or the initial balance was in. And then after that, the market moved up and it kind of just did nothing, So if you want to trade a breakout, you basically let it go up, you go down, and then you can get in here. But after that, it just really did nothing, other than at the end, break down and go down. Okay. So, you could have waited there until, because you had basically resistance up here and support here. Once it broke one of those, then you say, okay, now I'm going to get in once it breaks. And in this case, it would have broken down, and you would have made some money here. Okay. So that's just one way of trading futures using the IB levels. Okay. So now let's talk about finding a bottom. This is really important because every pattern always tells you, once you confirm a bottom, this is what you do. All right. So it's important that you learn how to identify a bottom. So I'm going to talk about bottoms. I'm not going to talk about tops, because tops are essentially the same, but they're harder to identify. Because they are. I can't explain why. They're just harder to identify. And that's another reason I like to trade long most of the time. Okay? Why fight it? All right. So now I'm watching the market. Okay? And you guys are too. So just pretend you're watching a live market. Okay? So now we see here that there's a bottom. Okay? It appeared right here. So it's a pivot point because it went down here. That was the bottom, and it moved up again. So now what happens is that bottom tested and it failed because it broke this bottom here, right? And it's going to do this several times. As you can see, this thing trying to go up, but then going down and breaking the bottom again. Tested it again there, and it failed. Formed another bottom here, went up, tested it, okay, and then it formed another bottom. Now there wasn't even a test at that point. The market just went up, and then it went up here and it went down, but never touched this area. And again, you're going to see this pattern over and over again. All right, so it basically made a higher low here. And that tells you, okay, now it's a reversal. This is a reversal. So let's put this on a longer time frame. So that whole time that we were looking at was from 10:30 to 11. Okay, until and this is now the 5-minute chart. We were looking at a 1-minute chart. So that time frame now went up and it went down, but it never touched or tested. It did test. So this is considered a test of the bottom, but it never breached it. Okay. And so after that, it went up again. Okay. So now this is a tradable position. And this is where you would take the trade, right at this green candle at the earliest time you possibly can. All right. So let's look what happened here. We had a series of higher lows. Okay. that happened, and then another series of higher highs, right? And so as long as that's happening in a trade that you're long in, you want to stay in that trade. And when do you get out? Well, you can see here that this made a high. Now here it went down, but then it tried to go up, but it didn't really take out the high. Okay, so at that point you had a lower high, and once you confirm that, that's where you would get out of the trade. So this trade would be finished right here, and you would get out, and you see after that it went down, it just kept going down. Okay, and you can even say, okay, so if we had a lower high, this is shortable. So you could have shorted this, put a stop above this area here, right, and let it run down until you had, a nice profit. Okay, so you can trade it both ways on that. Hopefully this is helpful to you. Okay, it's kind of meticulous, but if you have time sitting in front of a screen to identify a bottom, this is what you do. Okay, this is what I do. But I don't have to look at it. I just glance at the charts, and then you pick it up. All right, because you see these patterns over and over again. All right, and again, I promise you I will answer all your questions. Okay, so let's move on. This is the chart of this morning that I actually created, right? I took a picture of this chart, and the reason is because it is a perfect ABCD pattern. Now you may not see it, but in a couple, in a second here, you're going to be able to identify, man, this is an ABCD pattern. All right, and if you do this over and over again, you don't have to draw the lines. You see them. Okay, now like I see them, they're invisible to me, but I see them. Right, so this is what it is. It's a perfect ABCD pattern, and I'll tell you why it's perfect. So there's A to B, B to C, and C to D. And so what do you see here? Okay, this A to B is almost exactly C to D. All right, that's what makes a perfect. And then you have the zigzag in the middle, right? There's a nothingness here. This is basically a congestion area. And I drew here a pennant, basically, and this is a bear pennant or bear flag. Market's going down, it's trending down, runs into congestion, right? Sometimes it'll go up, but if it's in a trend down, it's going to continue going down, right? And so you don't want to trade this here because it's all over the place and very sloppy. You want to trade it when it breaks, okay? So this is what makes the ABCD pattern, and a lot of traders will trade this here at the D part, okay? I trade at the C part. I like trading at the C part, not the D part, because the D part, here you're going long, right? Now this morning, I actually took this trade, right? I took this trade because I saw the symmetry of what was happening overnight, right? And I said, this is about to reverse. Okay, so you have to wait for a trigger for it to reverse. And this low here, and this is an hourly chart. Okay, this low here was an extended candle, and it was basically a reversal candle. Okay, and then I got a nice green candle here, no more red, and I said, okay, this is where I'm going to enter. So I entered this trade this morning, and I got out right around here. Okay, and I traded it with both the MNQ and MES trading, and they trade very similarly. All right, so and I actually made more money with the MNQ. So I traded MNQ and MES, right, and it was a few hour trade, right, but it was $300. In that with basically 2 contracts, and it made me $300. Okay, so that's how it worked out. And again, you can see these patterns over and over and over again once you start trading these patterns.